Welcome, and in this video I will give you an update about my Q4 expectations. Have we peaked in the crypto cycle? Have we peaked in stocks, or are we seeing further upside? I have a lot of new data which I haven't shared before, which is really interesting. If you do not have a lot of time, just scroll to the end of the video. You can see my conclusion, but it will be worth it. So let's dive straight into the content. The first thing that I want to share with you guys is my custom recession indicator. I share it on my X profile, which used to be Twitter, every single month. And there are some very interesting comparisons which I wanted to share. Basically, I am tracking various US data metrics such as federal funds rate and so forth, and I'm giving them a red or green score. Green is basically good for the economy and red is bad for the economy. And if you want to look into these data points, just pause the video. I will just keep it short this time. Last year, at the end of 2024, in the last quarter, we had an elevated percentage where the recession indicator had a 58% chance of hitting a recession. It was the highest level that we have seen so far since I started tracking the data in 2022. And so the odds were above 50% that we would roll over. Now, I have to say that we did not roll over, but what we did see was the next quarter, we had a 20% correction on the SPX. So while a recession wasn't yet active, we did see a significant pullback, which is really nice to see that this recession indicator does indicate that there is turmoil or trouble in the markets. Right now, we are sitting at levels of roughly 50% once more at the end of September. And with government data being delayed because of a government shutdown, we may be trending up without us knowing it. So keep an eye on this indicator. If we trend above 50% in Q4 once more, then I do believe that at the very least, we may see another bigger size correction in stocks and potentially crypto because they are correlated even. So my recession indicator is pointing to danger, and we have to look at other confluences to see if that gets validated or not. And as you all know, I want to focus on what the Fed is doing as well. Right now, the Fed has a dual mandate. The first point of that mandate is inflation. Well, if we look at the data right here, you can see that roughly in 2021, we saw inflation spike, and then it moved lower once more. You can see that in the red arrow. We chopped, if you look at the right side, let me just decrease myself so you can have a better view. If you then look at the right side, then inflation basically chopped, but it broke lower. So inflation is no longer an issue. Historically, the Fed has said that they want to keep inflation to 2 or 3%. That is the mandate. That is a goal. If you look at the specific numbers right now, we are around those levels in the purple zone. If you look back all the way into like the 1950s, you can clearly see that sometimes inflation is higher and we see spikes, as we have seen in the 1980s, which is obviously an outlier, but sometimes inflation is also a little bit lower. The mandate says 2 to 3%. We are in that range. That part of the mandate is basically met. The Fed is no longer concerned about inflation right here. And as I have also been saying for a long time, inflation has been trending lower. A better gauge to basically judge whether inflation is good or not is trueflation, because inflation in the CPI basket is a highly edited and manipulated number. Whenever something happens, inflation spikes, the Fed excludes certain parts of the economy, where high inflation is present, and then they just artificially bring the number to whatever they want. So I like to use trueflation because it's a better representation of the actual inflation in the US, and even trueflation has trended lower to roughly 1%, 1.2% in April of this year, and is now back at levels around 2.2%. So the current CPI reported number is aligning with trueflation US inflation data, which basically imply one more time that inflation is not a problem. What's the other part of the Fed's mandate? The other part of the Fed's mandate is unemployment. And this is one of my big concerns in Q4 and going forward. Whenever the Fed starts to cut rates, as you can see on the top chart, then soon after we see a recession, which you can see in the gray area. The reasons why we see a recession is very often because the Fed is cutting rates because there is strain on the economy. Higher rates provide tighter liquidity, tighter margins for companies, and the economy in general slows down. Lower rates loosens financial conditions in general, and that basically boosts the economy. Now, what we are seeing right now is what we have seen many times before. The Fed starts to cut rates, and in the meantime, unemployment levels, they go back up. And this time is not different. If you look at the right side of the chart, you see that we clearly bottomed out. We moved up. We basically paused for a while, but we are moving up higher once more. As you know, the Fed is also cutting rates once more, and this while unemployment is going up. This is very concerning because if you look at the comparison on this chart, then you can clearly see that very often when the Fed is cutting rates, there is actually weakness in the economy, which we can see in the unemployment levels, and unemployment is rising. And that's something that they are also watching, and they will adjust their policy considering this. So basically, we bottomed out in 2023. This is once more the last cycle in unemployment. Then we had a clear uptrend, which got broken. It got broken near the summer of 24, and then we went sideways. So that's actually a really good signal because, unemployment remains stable. But now we recently have seen the highest print so far, which is 4.3%. And it is concerning because it could be a breakout to the upside, and we could start another uptrend in unemployment. And that is negative for the economy going forward and a signal we should watch. Now, another indication where we look at employment this time is the current one. Corporate earnings lead employment growth. So we basically look at the private employment and we look at pre-tax profits, and they often go hand in hand. Whenever the pre-tax profits go negative, we see a signal of employment tracking that, which basically means that we see weakness in the economy, so there's less profit, so they need to cut jobs. We have seen that many times, as you can see in the chart. Whenever the actual pre-tax profits go negative, soon after, it could be months, it could be a year or longer, we actually see employment moving lower as well, because companies have to balance out what they do and their profit margins. We are currently seeing a downtrend in pre-tax profits once more, and we also see that same dynamic with employment moving lower again. It is not yet negative, but there is a clear trend, and that trend is negative. So it is negative for employment. So here you can see profits have slowed but are not shrinking yet. This is also a concern, what I just mentioned, that employment could go down and then one-on-one, unemployment could continue to go up. So we should continue to watch what these dynamics do. Another correlated chart I wanted to share here is consumer perception of the job market versus the unemployment rates. So what we also see is that whenever jobs are plentiful, less jobs hard to get percentage. When we see that jobs are not that plentiful, let's say, then the perception of people who think that is the case is often a leading indicator for unemployment as well. There is also a big correlation between what people are feeling about the job market, the actual consumer perception, and what is happening in the economy. Because very often you can find a job just harder. You see and hear people getting fired, etc., in your environment. So we are currently seeing that the gray line is going up and that unemployment rate could follow this move upwards, which basically means that unemployment could continue to move higher, which is bad because the Fed will adjust their policy on that because they do not want that. And that basically signals that, once again, the economy is struggling. Another important data set about employment or unemployment is the non-farm payroll data. I'm looking at the data revisions. So we get the actual data points and soon after we also get the revisions. These are the revisions and here the trend is the same. You see that employment is going down, and if you just pause the video, you can also read my tweet and you can actually read the actual numbers. We have a very negative NFP trend, and that is usually a pre-signal for a recession. This, in combination with the fact that my recession indicator is sitting back at 50% and maybe ticking up into 50-60% range once more, could be an indication that we either see a recession soon in the start of 2026, or at least a market pullback. So that is concerning, and we should continue to watch these trends. This trend is about to roll over negative. It is very negative generally. Now, let's be honest though. Yes, unemployment is concerning. The unemployment rate is going up, but let's not forget to look at the cycles. Currently, unemployment remains well below the average of 5.7%. So even when we see an uptrend, we are coming from one of the best levels we have seen in a very, very, very long time. Last time that we bottomed out at 3.4% was somewhere around 1969, and prior to that in the 50s. So yes, it is concerning that unemployment is moving up, but on the flip side, we are still well below averages. So we have to take it in measurement that it is concerning, but we are still sitting at 4.3, whatever level, and it is still historically low. I just wanted to add that to give you the correct perspective. We have to continue to watch unemployment, and I will continue to report on it on my X channel. So if you want to be there fast, get the info straight away, then you have to follow me there. Okay, so inflation is solid, not an issue. Unemployment is an issue. We are watching that. Different kinds of metric talk about increasing unemployment going forward. That is very concerning. What about the consumer? Consumer is 70% of GDP. If you look at the left, you can see that generally, if you look at the consumer and we look at disposable personal income, if we look at real wages and salary income, and if we look at disposable personal income minus current transfers, all of these charts are in a bearish trend. We are seeing the consumer still struggling. We are still seeing a concerning markets for the consumer. The flip side to this story is that when we look at delinquency rates on credit cards, for instance, we do see that we have peaked around 2024 and we have rolled over and are now going flat, as you can see on the chart. And the same with consumer loans delinquency rates. We have gone up, but we are going flat right now. This is actually a bullish indication that things are slowing down, but we should continue to watch if things pick back up. That would confirm the issues like with unemployment, etc. And that would be concerning once more. Right now, I would say we are seeing mixed signals, but overall, the bottom 50%, they are struggling. And I put that in my recession indicator at the start as well, because yeah, I see that all around. Now, there is also another mention that I should add to this as well. And that is that 50% of the spending by consumers is done by the top percent earners. So like the top 10%, they spend 50% in our economy. And that top 10%, which contributes to half of spending, which is necessary to keep the economy floating, because as I said, consumer spending is 70% of GDP, then it's important to look how they are doing as well. And they are currently enjoying of what is called the wealth effect. And the wealth effect basically means that those 10% top percent earners, they have assets, they have stocks, and stocks are going up. And that basically means they have stocks, they have cars, they have houses. Most value is going up. Their net worth is going up. Likely their spending is going up as well because they got more money. They're doing good. So while the top 50% is struggling, we also see that the other half of that spending is actually doing really well. And that basically confirms that we are seeing like a two-speed economy. We see like the bottom half of people struggling, but we see the people with assets, with money, also spending a lot. And that is currently imbalance, keeping the economy floating. We also have what is called the winner's curse, and that is over-optimism in markets that is driving up asset values. Think about the current AI situation. There is a lot to be said about it. There's a lot of money rotation. I do not have to talk about the topic, but there is a lot of hype around AI, which is putting out a lot of optimism, speculation into various assets, and currently so many different kinds of sectors of assets are going up. This is called the winner's curse. And while we are in the winner's curse and while we are in optimistic markets, values tend to go up, which is a positive as well. So as I said before, people without assets, the bottom 50%, they are struggling. Now, equities are giving us a signal as well that we should be on a watch out. The left chart, you see the weighting of the top 3 holdings in the SPX. And at the right, you see the weighting of the top holdings generally in the SPX. And if you look at the period from 1980 to right now, which is over 40 years, then you can see that currently at the left chart, Nvidia is a very big holding. Nvidia, Microsoft, and Apple represent 21% of the SPX. Those companies alone are dragging up markets, are dragging up the SP 500. If we look at past cycle peaks, then we notice that the concentration was a lot less. If we look at the right chart, we see basically the same. The top holding is Nvidia, 8.2%, very big, and it basically overrules all previous top performers, let's say, top holdings that we have seen. It is clear that we are in some kind of bubble. Now, bubbles can continue far longer than that we can remain sane. But this is something we should be on the lookout for. We are not in a value market. We are sitting in what I call a seller's market. We are sitting in an elevated market with high valuations. So we often see that these kinds of concentrations like to occur at market peaks. So we should watch out if this concentration rolls over. Will it be a broadening of the market? So like we have a concentration and then the money rotates into the rest of the market. That would be healthy, but it could also not be the case and then it would be unhealthy. This is something we should continue to watch, as this could be a very bearish signal as well for the markets generally. One more thing I want to mention is if we look at the Russell 1000 and we look at the ratio growth to value, then we also see that we are at elevated levels. We could, if we look at prior peaks and we combine them and you look at the red chart, we could continue to see higher highs. So we could actually see further outperformance of growth versus value, but we are close to a peak. Either way, we are not at the beginning of the move, we are nearing an end of a move. possibly an end of growth outperforming value if you look at this chart, which is also something we should keep in mind in our portfolio. Something different is the SP 500 price to peak earnings ratio, because people like to talk about PEs, and also the operating profit margins. If you look at the price to peak earnings ratio at the left, then currently we are also sitting at very elevated level if we look at averages. So on average, we are sitting at 27.9, which is historically high. We have only one occasion, which is a dot-com bubble, which was higher, and eventually those ratios unwinded back lower to the median. The median is currently 17, and we are well above. As you can see, we have been well above the medium since, let's say, 2016. So we have been there for 10 years. We could continue to grind up for a couple more years, but generally speaking, the market is at elevated levels. If you look at operation profit margins at the right side, we see the same picture. We are sitting at very high levels, well above the averages, and we all know that eventually averages are there because prices fluctuate around them. So what goes up also goes down. I do want to add that these are not necessarily like top signals straight away, but these are general trends that are concerning. And I also believe that we have to be on the lookout for for locking in profits, because there are a lot of indications already right now that markets are elevated. So if you have some really good performers, I would expect as time goes by, because people have easier access to like the internet, to Robinhood, to investing, these correlations should be higher because more people get involved. And we can run longer before we see a downturn, but we are already sitting at peaks, and even if we move higher here, we could move a lot higher, but eventually we will go back to the norm. If you look at leading indicators, then we can see we already had a rollover of the fast line. At the right side, you can see whenever the red line moves lower, the blue line, the lagging line, eventually follows. And whenever the red line crosses negative, we often see a recession, as you can see in gray. And right now we have crossed over. It's a leading signal, which means it's often faster than the actually turnaround. But soon the trend of the blue line, the lagging line, will hug negative, which is often where a recession is confirmed. We also see the coincident indicator index, and that one as well has shown that post-COVID, the markets generally have been running flat. The data has not been impressive. I've been reporting about it as well. It has been a mixed bag. And while we are not turning negative, we do see a rollover in the fast signal as well, which is going lower slightly, and it is also concerning. And you also have to remind that the damage to the economy is done in the years leading up into a recession. And the leading indicator is an indication that we may be building up towards the same kind of environment in the not so distant future. So while it is not here right now, it is an indication of potential issues along the line. Now, it's not all negative. If we look at Q4 and at early 2026, we do see that like October to year end, probabilities for stocks are generally positive. If you look at whenever we had September rate cuts, then on average, we do see positive performance as marked in red, 4.3%, even up to 13-14%. I've been saying that as well. I do think that economy is slowing. It's going in deterioration mode once more, but the markets and economy are not one-on-one. And while economy is going bad, markets can continue to grind up. And that's basically what we are seeing right now with some headwinds as rate cuts fuel market sentiment a little bit more, and we see higher prices. When we also look, let me just change my screen here. If you also look at the right number, new highs in September are often a good signal. On average, when we look at the data year to year, we can expect a few percentages higher if you look at median or average percentage returns from October going forward to the end of Q4, which basically once more proves that 7,000 SPX, which I have been talking about for quite a while now, is a very conservative target for the markets to reach. Also, technically speaking, a level that could attract price. Let's look also at the Nasdaq. We have seen 6 months up in a row. What does that mean? 1 year later, or even if you just look at Q4, 3 months later, that means even higher prices. 100% correlation for higher prices, on average 8% higher. This is bullish for crypto and equities and small caps as well. So at least in the short term, I think the upside is big on this as well. Let's also look at different kinds of assets. If you look at assets like gold, large caps, small, whatever, most markets have been trending up this year. Every market has been going up. We are in a leg of the market where we are seeing some kind of melt up, let's say, some kind of move up. And that is often an indication of a strong market, a bullish market. So while there are concerns about the peak, right now I do not see such structural damage that I should sell everything. We are seeing massive returns that may continue for a little longer. Let's also look at the SPX on the chart. The barometer, which is basically the orange line, that one has been very accurate for the year. I've been posting about it the whole year, and it also mentioned that we could see a downfall, a correction of 5 to 10% in the SPX, getting us back to that 59 or 6,000 level before we continue our grind to 7,000. And right now, it seems like some kind of correction is taking hold. The flip side is that when we look at performance after September rate cuts at the left side of the screen, then you see that on average, if you look at the cycles that follow from that, all cycles went up. Prices went positive from that point forward. Only in one occasion, 2007 in the green, when we had a recession, we trended lower. On average, if you look at the peaks of those moves, then between 40 and 60 or 65 days after September rate cuts, we can see a peak in markets. We have seen our first rate cut at the 17th of September, roughly. And so far, we are not close to 60 days after, which basically means that we could still see upsides looking at averages going back in time, which implies that we are within a couple percent of 7,000. It is still a level I think is very likely to be touched before year end. If we look at US economic expansions in a cyclical way, then we can see that the cycle from 2020 to right now is about 62 months old, and on average, bull cycles lasted 67 months. So we are still well below the average here as well. That is also a bullish catalyst. And if you look at the average monthly returns since 1990 for the SPX, then we all know that seasonality is very strong in Q4. If you align this with like crypto seasonality, which is also very strong because we are nearing the end of the cycle, then I think chances are high that we could see positive performance in Q4. If you look at Q1, which is also important, all the way up until April, we often also see a rollover effect. And I talked about this last year as well. And this time it could be the same. So for crypto and equities, there could be continuation going into next year, but it all depends on the data we are tracking. Let's look at liquidity. We have 4 liquidity measures. I post about liquidity every month on X if you want updates about that. Generally speaking, domestic levels for the banks, left upper corner, are at low levels. This is very concerning, but we haven't broken down just yet to what we have seen in 2023, the March banking crisis we have seen then. We are still hovering above those levels, but we are flirting with them. So we are still in a range-bound condition, which is positive. When we look at cash assets of large and small banks and the reserves that they have, we are also still above levels that they had in 2023. This is also very, very positive for liquidity. RRP has been depleted. I said that as soon as this occurs, the Fed will stop QT. The Fed has now announced in due course, a couple of months, we will stop QT. That is also a tailwind for markets. Liquidity conditions are improving. The TGA account has been depleted and refilled back to the levels they wanted. As TGA gets refilled and they put money back in the treasury account, this is negative for markets, and right now it has been refilled, so that negative pressure is no longer in the markets, which is positive. When we look at sentiment, and let me just do it like this, sentiment for equities, the NIME indicator is also hovering about, roughly around optimistic levels, but not like overly optimistic, not overly bearish. It is basically flat and giving a non-signal that is neutral. The fear and greed index is sitting at fear, which is a good signal because we were really elevated in stocks, but that sentiment is changing. We are seeing the same with AAIE sentiment on the left lower corner. We are back below the average historical numbers for the bulls. The bulls are diminishing with this wipeout in stocks, which has been less than 5%. Sentiment is not overly bullish anymore. When we look at crypto, we had the biggest wipeout event in a long time. And we are back at low leverage levels. We are also sitting in fear, and we have been sitting in fear for a long while. The last time we saw extreme greed in the crypto cycle was a year ago when we had a solid Q4. Right now, levels are neutral to bearish. So I do not see sentiment extremes here, which are concerning for me to sell based on sentiment. Certainly not for crypto, because we just had a big event there, and we had some very negative moves. So what am I looking at? Looking at all this data and trying to provide you with some more cyclical data this time, and not the typical indications that I always update about. What do I think is happening? I do still think that equities, as you can see, are in an uptrend. I think the worst case would be that we move to the 6,000, 5,900 region, as the barometer suggests. After we touch that level, I still think we could see upside of 7K before anything really rolls over. So this would just be a 5 to 10% pullback, which often occurs. That is still possible. That is still in play. But I still see that we could see more upside. 7,000 is my conservative target. I scaled back in April into equities. I mentioned that. I scaled 10% more after we broke the resistance levels of August, but I'm still sitting at 60% cash. I still think that this market is not a buyer's market, but this is a seller's market. But the EMAs are still healthy, price is healthy, and I'm expecting, worst case, a pullback in the next couple of weeks. And then I still think we can move higher depending on how data comes in. So nothing really concerning for me. When we look at momentum indicators, we look at volume and other kinds of indicators, they are all pointing negative. So that is why I'm leaning towards some kind of retracement. And we are seeing that right now. How deep, how far, no one knows. Neither do I. But right now, the recession indicator is hovering around 50. So it is concerning, but not too much. We are still seeing a lot of mixed signals. And when I see that, my experience has been that it's good to continue to take profits where you can take profits. Do not scale in, but also do not sell everything and go into cash straight away. We want to see some further deterioration from this point to be a sell signal for us in equities. So right now, I remain constructively bullish until proven otherwise. Same for crypto. Q4 is the best period to be in crypto. We could see some bearish pressures. If stocks go down now in Q4, crypto will be dragged along. It could be that the liquidity tailwinds come into effect, like Fed cutting rates into year end. That could loosen financial conditions, could be positive for crypto. We could see upside going into Q1 of 26. So it means that the crypto cycle may be extending because of liquidity conditions and the macro. Certainly with the government shutdown, data gets postponed. That drives markets in some kind of speculative environment. You never know. I was very constructive and bullish about crypto near the start of October. I wanted us to break the all-time highs for altcoins and for Bitcoin, but I also mentioned what I'm showing on my chart. Many times before we started crashing, I also said if we reject at this current high level of 125,000, then the barometer, which has also been very accurate, could indicate we validate the megaphone structure, which is in blue, and we could see a move for crypto down to the 100K level. Yes, that is negative, but still, considering everything, I do not see a signal that this cycle has ended or has concluded for crypto. I strongly believe that we are yet to see a lot of upside because the Bitcoin dominance hasn't dropped significantly. We have not seen the rotation into Ethereum and other altcoins, which we always see in prior cycles. And I still believe that even with people buying ETFs and whatever, I still believe there is some validity to the crypto cycle. Money will flow from Bitcoin to alts. The Bitcoin dominance will drop. There is a correlation with liquidity. I still see like data deterioration, but markets potentially moving higher, and that would be the same for crypto. I do still think Bitcoin can see higher prices. I also believe Ethereum can still make a new all-time high between 6,000 to 8,000, and I also still believe there will be some kind of rotation of out of all those sectors that performed this year, gold, whatever, into the crypto space, into small caps, and they will see some kind of muted alt season. I do not think many altcoins will make new highs considering what they did in 2021, but I do think many will retrace towards the highs made in 21. If you are a hyped sector, if you are a new narrative, if you are an active narrative, which is now like real world assets and so forth. So I like to remain exposed to crypto in Q4. I will look at the end of the year if there is a lot of danger in stocks. Perhaps I could scale down significantly if that is the case, but I still believe so far that Q4 could be very bullish for crypto, but we have to see what price does in the coming weeks. As I posted about on X before, prices can trend up aggressively in a short period. Alt season only takes 1-2 months or so, and prices go parabolic. So I still think there is some profit to be made in the space. I remain invested while I'm only selling from here on because, yeah, the cycle is near an end. Even if we extend, I'm looking generally for stocks and for crypto, I'm looking into what is happening at the end of Q4. Does data continue to deteriorate? If so, I will be scaling heavily into cash more and more. If data remains all right, as it is right now, then I expect a rollover into Q1, as we have seen last year as well. But then it's starting to get very dangerous. I will be actively selling crypto. I'm no longer buying. And yeah, we will see what the coming months give. I will give you more updates as we go on my X profile. And I hope you enjoyed this video. Please give me a like if you liked all the content and share it with your friends if you find it valuable. This way you can help my channel grow as well, which is lovely. Either way, have an awesome day and I will talk to you guys later. Bye bye. Take care.